the idea, did not in his paper of economic man or the rational man did not mention that the economic man was irrational. He said that the model of rationality needs to be reworked. So this was his paper, and he said that the behavioral model of rational choice, and he said economic man is assumed to be rational. He is assumed to have knowledge. He's assumed to have a computational skill. He's supposed to have an ability to calculate. He's supposed to have an ability to be objective. He's supposed to have an ability to uh, um, weigh the weight of evidence. And he says that the economic man is supposed to be or is assumed to be well organized, and he is assumed to have a set of choices, a stable set of choices. He has supposed to be supposed to know what he likes, what is his risk profile, what is he what is his way of investment, and and um and it is and he also said that the economic man assumes, or economic man is assumed to have a backup plan, an alternative plan. If a current plan fails, then he should have an economic or a backup plan. And it's also assumed for the economic man, and he said that he has the capability to move through the puzzle, or move through the structure on his process, on his method, and somewhere find reach the highest point that he can attain. There is a certain highest point an economic man can attain, and with his skill set, with his knowledge, with his abilities, and he is capable to reach there. And this is what he said, that this was the classical economic thought, which he said that needed a change, because it was not completely correct, and it needed to be reworked on. This was the starting starting paper of um, behavioral finance. Then there was another paper he wrote, and which somehow is lost, and lost means it is not being given that kind of importance. And this was the paper where he like Herbert Simon was trying to explain the architecture of complexity. He was trying to explain that uh, how complex systems work. For him for him society was complex. For him, how we communicate, how stock markets work, how nature works, it was a complexity filled system, and he tried to understand how this complexity works. And somewhere he was trying to explain the Pareto rule. And the Pareto rule we discussed prior, we talked about it. We mentioned that the Pareto rule is the 80-20 principle. It is Pareto rule looks like a curve, which is exponential in nature, and which says that prices the majority of the time move sideways, and do not cause a net change. But in a short period of time, there is a lot of activity. So there is a lot of time prices are sleeping, underperforming, stagnating, and in a very short time they can also trend. And this was similar to the idea which he prices, which say 80% of the options expire worthless. Only 20% of the options really are exercised. It is all over the place, and we have already spent some time explaining this. So Herbert Simon was somewhere trying to explain the Pareto rule, because this is a rule which has not been challenged, and somewhere understanding complexity in nature, understanding complexity in market, he was trying to explain why the rule works. And he he was he talked about the complex structures. He said that complexity was a kind of a tree, was took a form, took a structure of hierarchy. He said that um, that complexity had a structure. Complexity had had a system, had an order, had a geometry, and he said that hierarchic systems had a common standardized structures, and they were independent of specific content, whether it was a complex system in stock markets or whether it was a complex system of understanding human psychology, whatever it was, they the structure was independent of content. Now, this is a very large thought again, because we give us so much emphasis on product knowledge that if I am if I'm a trained scientist, I can understand science. If I'm a trained in stock markets, I can understand stock markets. And I have to be trained for that area. But he says that if stock markets are as complex as some scientific process, then their systems are similar, which are independent of the content in them. Now, he basically saying was trying to say that to understand the system, you need to understand the how it is designed rather than what is in the system. Because if you understand one system, you can understand many systems. So he was broadly trying to explain that why um, nature is similar to stock markets. And there are so many people now saying that nature is similar to stock markets, and how the earthquake behaves, and earthquake shatters, or earthquake causes a change, is similar way how stock markets behave. There are actually papers being written on it, that how earthquake science can be used to forecast markets. So of course these ideas came much later, and these are in 1990s, rather in near 2000, that such papers were being written. And he was talking about these ideas of similarity in nature and stock markets in 1962. So he said that the systems were related. Now again in 1962, he said that markets were related. Markets, whether it is metals, energy, or it is anything else, they are related. Intermarket analysis, it was written later in 1990s, and he was already talking about beyond markets, that even nature and even society, even psychology, everything is connected. They are interrelated. And he said that all of them are hierarchical at lower stages, and at a very elementary subsystem. They have basically a simple unit which subdivides and becomes a larger system. So he also did some work where he said that if you take social interaction between societies, and if you are he also wrote about that if you're doing conversation with your friends, or if you're interacting, of course, now on a social network, your social network interaction might look very random, but there is an order you can draw, and actually a pattern how you behave on the social pattern, on the social network also. There are, if you have 100 people, the 20 of the people you will interact with more, 80 of the people you will interact with less, 20 of the people you will be spending 80% of the time, and 80% of the people you will be spending 20% of the time. So the similar structure is also in your social network. Rather, I was sent a link from a friend who was talking about how the Twitter can be used to understand markets, how frequency of words, or how the what is being searched can also tell a lot about forecasting. There is a forecastability using Twitter data. Now, this all may sound very strange. How can Twitter tell us about stock markets? Now, these are the interrelatedness which Herbert Simon was speaking that time is still relevant today, and is still being discussed, and is still being explored 50 years from when he wrote about it. So he said whether it is symbolic or it is um, any any kind of system, they are self-reproducing systems. Now, 1962, he was not he. I don't know whether he read about Eliot or but he was a scientist, and he was somewhere he was somewhere talking about uh, self-reproducing. Now, self-reproducing again comes to a similar idea which we talked about, where we said that Elliott waves are self-reproducing or they are self-subdividing and they are a system. Now, this again is again a similar structure. Self-reproducing are also about fractal structures. There is a life in a five-wave structure. The five-wave structure subdivides and subdivides and becomes a larger five-wave and so on and so forth. It is a self-reproducing system. Markets are a self-reproducing system. So he basically said that complexity had to evolve from simple ideas, simplicity. And this again was something even Brancusi said that complexitatea este um, uh, 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 simplicity is solved complexities. Este simplicitatea resolvata, resolvate. So, somewhere an artist also saw the same thing that a scientist saw. And like I said, Herbert Simon was trying to explain power law distribution, exponentiality in nature. But that paper was, of course, is of course not a uh, very quoted paper, very talked about paper. And we have moved on to proving that human beings are irrational, which again can be challenged. It is still being challenged by like on the academic circle. It's still being proved that it's not all true. uh, when it comes to the psychology part, and there are some experiments, of course, which Daniel Kahneman did, and Daniel Kahneman uh, basically said that the seller is smarter than the buyer. This was one of a very simple things he said. And why do you think a seller is smarter than a buyer? Any thoughts on it? Anybody wants to make a comment? Why do you think a seller is smarter than a buyer? We have so many traders here, and I'm sure that we can have some inputs on this thought. First, you can say that do you agree with Daniel Kahneman that a seller is smarter than a buyer? Yes or no? Okay, we have said cash is king. So cash is king. With that, does it mean that sell? Yeah, that is one smart answer. Cash is king. So a seller, a seller is goes in cash, and a buyer is with the asset. Anyway, this doesn't really answer the aspect that I'm trying to highlight here. The the seller finds ways to offer a product. Okay, so seller finds way to offer a product. So he's smarter because he finds a way to offer. He finds a way to. Anyway, if if the market was at an all-time high, maybe maybe we can ask about, we can see in context of a rising market. In a rising market, also a seller smarter than a buyer. We are talking about the psychological aspect here. What could be the psychological aspect which Daniel Kahneman wanted to highlight? The buyer only needs money. It manages to exchange something into cash, some something nobody probably will know how much is valued. hmm That's again a very interesting